First up today, we're going to be listening to Prime Financial Group. Can you please give a warm welcome to Prime Financial Group MD, CEO and Chairman, Simon Madder. Simon, welcome and over to you.
Thanks, Paul. Firstly, thanks very much for the opportunity and for attending here both in person and online. In terms of my presentation, which hopefully we can pop up right now, I will talk for about 20 minutes. Please don't hesitate to ask questions throughout. Love the interaction. And we're operating in a space at the moment which we find very exciting, and there are some great organic and inorganic opportunities around professional services and financial services generally. So just in terms of a bit about us and Prime, we are an advice, capital and asset management group. There are 4 key areas that we operate within the market. That's wealth management, accounting and business advisory, SMSF, and also corporate finance. So essentially we have those 4 streams, but how we try to differentiate our business is by connecting all of those things together for really 2 key segments: business owners and also for individuals and families from a wealth management point of view. We currently have about $1.2 billion of funds under management. 170 team members that are based here in Australia, New Zealand, and also overseas in India and the Philippines. We have an increasingly global footprint from a client perspective, and I'll talk a little bit about that in a moment. And we have been in business now for 25 years. So a bit more detail on what we do. And there's a bit of detail here on this slide, so I'll try to sort of pick out the key points for you. So we have those 170 team members across the 4 different service lines, and we also run a centralised or shared services model. We are one brand, one firm and one client value proposition that is implemented by a group of professionals at partner and director level. How we've tried to differentiate our business is making sure that our team owns 45% of the business and we work collectively to deliver a combined service for all of our clients. So from a wealth management point of view, we deal with quite typically wholesale clients, but we also have some retail clients in there as well. That's everything from financial planning to superannuation, life insurance, all the things that you would typically expect to see, where you can come in and have all of your financial needs looked after. There's 35 team members of the 170 that work within the wealth division, and as I said, there's about $1.2 billion of funds under management. That part of our business has a high degree of recurring revenue because we service clients on an ongoing basis and we charge a percentage-based asset management fee. Wealth management has had a particularly good period over the last year or two, and it currently makes up about 33% of group revenue. In terms of the corporate and capital and corporate finance division, this is one of our newer divisions that we established about 5 years ago. It makes up about 18% of group revenue, and the core work that we do within this division is helping businesses either raise capital or sell their business or undertake corporate development for them to help them grow their enterprise. So we do that across equity, we do it across debt, and we also incorporate within this part of our business our consulting, which includes ESG and also leadership as well. As I said, that business or that part of our business makes up 18% of group revenue, and that represented 0 revenue 5 years ago, and today it's about sort of $6 million of turnover. Accounting and business advisory. So we do a lot of work in the SME space. We do work with businesses that are pre-revenue all the way through to 100 million turnover. We have 55 team members doing accounting, tax, compliance, but strategy and business growth. So if you want to grow your business, you believe that you need access to a team to help you do that, it's more than just accounting, tax and compliance for us. 36% of group revenue and great recurring revenue within this business operation for us as well. On the SMSF front, we assist clients with administration and compliance. They're our own direct clients, but there are also 200 accounting and financial planning firms where we actually deliver for them the accounting, tax and compliance for their clients. We have white label arrangements where we basically act as the intermediary between the client and the firm. As I said, we also have a shared services model, a team of people where we don't need to keep on replicating in different locations. That's accounting, that's finance, that's IT, HR and operations, and that allows us to scale quite quickly, which is what we've been able to do in the last 5 or 6 years, which I'll speak about in a bit more detail shortly. So why Prime? It is for us absolutely about this one connected ecosystem, coming to one group to get all of your needs serviced, whether it's from a wealth or a business perspective. We have a strong focus on our team and making sure that we get the best possible talent, and we really do differentiate around our team owning part of the equity in the business. Once a team member's been with us for 12 months, regardless of whether they're a graduate or a more seasoned professional, they start earning equity in the business on the basis of the same metrics that I get incentivised to grow share price and earnings. It's a core point of difference when you're out there in the market trying to get the best talent. So ownership's a key consideration. We want to be proactive. We're not waiting for things to happen. We're trying to jump on the front foot, help our clients with their plans, their aspirations, and make sure that we deliver across those 4 key areas. Relationship focus. We've been in business for 25 years. We've still got a lot of clients that were with us on those very first days when we opened the business, and we very much value the relationships with our team and also with our clients. We've also got to be very accountable. We've got to do what we say we're going to do, and we have to deliver on expectations. And we're also very conscious of the impact that we leave as an organisation as well. So there is an ESG lens to how we think about the future. In terms of our track record, this is really just referring to the half year, but really the point I probably want to make here is that for the last 5 years, since we positioned our business as one total firm as opposed to being a firm that used to invest in other businesses within the professional services space, we've managed to achieve across all of our key metrics, whether it's EBITDA growth, whether it's dividends, various other things, we've managed to achieve between 20 and 40% compound annual growth. What we learnt from the first sort of 20 years of being in business is you have to back your own vision, you have to recruit a team, and you have to be able to put it all together better than probably what others are trying to do. And that's our mission. That's what we're trying to do. So in terms of our growth ambitions, we've been very explicit about where we see this moving for the future. So in FY22, and this is a key point to make, in FY22 we had $26 million of revenue, and we spoke to our investors and we said, we believe we can double that revenue to $50 million by FY25, and then double that revenue again to $100 million by between FY28 and FY30. We're on track to achieve our $50 million of revenue for FY25. We are continuing to forecast an expectation of 15 to 20% revenue growth for this year. So what we've been able to do is we've been able to start to drive the business very well from an organic growth point of view, and we're now adding in acquisitions that are allowing us to increase the size of the audience that we have to offer more services. So we're driving organic growth across all 4 of our divisions, and I'll show you a slide which hopefully I can articulate, and you can see how we're growing that from a wealth management, a capital point of view, accounting and SMSF. So all of our divisions are growing organically. We're also rolling out new divisions, so we have more services and we're a more complete offering for businesses and for individuals and families from a wealth management point of view. In fact, in the last 6 to 12 months, we've had our heaviest investment in new services, which is what we started doing really 5 or 6 years ago. And that's included debt capital advisory, so helping businesses access debt so they can continue to grow their business and finding the best possible outcomes for them. An area in sports, entertainment and media capital advisory. It's a new asset class is emerging. You'll see online that JP Morgan have just set up an investment banking and sports advisory division themselves. So this is an emerging area, an emerging opportunity for investors. Consulting, property. A lot of our clients really enjoy accessing wholesale property opportunities. That could be residential development. It could be anything within the NDIS space, which we're getting actively involved from a development point of view as well. We're also very much expanding the wholesale offering that we have for our clients so that we become the destination where you can get access to hopefully the best opportunities for the future. Acquisitions have only just recently started to feature in our plan. 17 months ago, we acquired an SMSF admin business that turned over about $3 million. We bought that business because it also provided us access to more accountants and financial advisors that we could help and deliver services for them and their clients. We also recently, about 5 or 6 weeks ago, acquired an asset within the funds management space, the alternative asset funds management space. That is a business that offers private equity and private credit investments for wholesale investors. We really like this space. Alternative asset investing has got a strong tailwind, and increasingly you're seeing this turn up in client portfolios. We like the space. It connects very well with what we do on the capital and corporate finance front. So we are going to continue to look at acquisitions. We've done 2 in 17 months, and we would expect to announce further acquisitions within the next 6 to 12 months. So in terms of the first half just gone, our revenue was up 14% to $18.2 million for the half. Our underlying EBITDA was up 2%. Our EBITDA margin was 21%. More typically, our EBITDA margin is around about 30%. when we're not investing in new service lines and having that cost attached to employing people to roll those out, it takes around about 12 months for a new service to start to break even and then deliver us a positive contribution to earnings. But to be clear, not everything we do works out from that point of view, and if it doesn't, then we just cease to operate within that space. Anything new we do, we have a view that within 3 years, it needs 3 to 5 years, it needs to get to $3 to $5 million of turnover. That's the business case that we run internally. We spent around about $2 million on acquisition costs and also on investing in new services, and that's why our reported earnings were down for the half, but we did continue to increase our dividend for the period. We paid approximately 60% of our earnings as a dividend, so it's quite unusual for a micro cap business that has a 50 mil market cap to have a consistent dividend, but we paid about 60% of our earnings, and our dividend increased for the half by 7%, and we had just implemented a dividend reinvestment plan as well. Our debt is about 1.4 times our underlying EBITDA. Our target is 1 times, which is where we want to be by 30 June. So really the key point on the past slide and also this slide is we continue to grow. We've found a mechanism with which to grow organically, and we're adding to that via acquisition. So what you're seeing here, or not seeing here on screen, is 14%, 31% and 14% revenue growth over the previous corresponding periods. And probably an important stat that allows us to continue to invest in the business is that 70% of our revenue is recurring in nature. That means that the customers and the clients that we have come back to us for ideally not just the services in one division, but in multiple divisions. It allows us to predict more where our earnings will be in the future. This slide, which hopefully, I guess at least if you can't see all the detail, you can see how it's been growing. What you're seeing there is our wealth management division for the half versus the previous corresponding period was up 38%. That is being driven by some of the origination and unique wholesale investments that we're offering to our clients, particularly around property as part of their overall asset allocation. You're seeing there the capital and corporate advisory division was up about 12%. Although it's a difficult market at the moment to raise capital for companies and activity is down about 35 to 40% versus the average, we were able to grow this division because we added more services within this. That included the debt capital advisory, where we were able to gain clients and offer services and value there, and also the consulting piece as well. So that part of our business is more diversified. On the accounting and business advisory front, that was up 3%. Typically, we'll see that for a year being up 5 to 10%. We'd expect it to sort of return to that level for the full year. And our SMSF division was up around about 1%. We've been integrating the acquisition that we made about 17 months ago, including the tech platform. I'd expect that to start to move into more of a pro-growth structure over the course of the next 6 to 12 months. So I guess the point to take away from that previous slide is really just about the diversified nature of our revenue and the different markets that we play in. So when a particular area might be down, like equity capital advisory, we're able to substitute that in other parts of our business like accounting or wealth management. What this slide is showing is quite simply the two segments that I've spoken to. So these are where the clients are that we are going to try to find and deliver multiple services to. So businesses, emerging businesses, is where we think we can add a lot of value. So for those businesses, it'll be business advice, it'll be strategy, accounting services, virtual CFO if they don't have a finance department of enough structure. It could be anything from ESG consulting to helping them with acquisitions and funding that. So when they're seeking to grow their business, we ideally are the party that they come and speak to. Wholesale wealth management for us is not just about financial planning and looking after the overall asset allocation for a client. It's looking after their self-managed super fund. It's finding unique investments in the alternatives and the property space. That's where we're able to differentiate in what is quite a crowded marketplace. So our strategy for growth is straightforward. It's what we've been doing for the last 5 to 6 years. Top line growth through new services, cross-delivering more services to our existing customer base, and also finding new services that have higher margins and that are valuable to our customers. We've also got the benefit of leveraging that centralised finance, IT, HR, marketing function so that when we decide to move into a new area, it is literally just about hiring a new person or people and you're then just taking the risk on the cost of that labour as opposed to having to reinvent the wheel. So we are driving margin expansion. That comes from scale. It comes from being in services that clients need that are growing and where we can generate a good EBITDA margin. So again, margin expansion will happen. We'll continue to get back to 30% plus at the EBITDA line, but we're in a heavy investment stage at the moment. The investments that we have made in the last 6 months in people to grow organically, we've capped that out now. We don't need anything else to surround that client with more services, so we've made that investment. We're also, at the same time, acquiring other businesses, which will become more of a feature, and we'll use that balance sheet, that strong balance sheet that we've got, and the funding arrangements with Westpac to allow us to continue to move forward on that front. We are a business that thinks about our purpose and why we're here and what we should be doing. So we do have a commitment to the UN Sustainable Development Goals. There are 4 key things that we look at there. We're proud of the fact that we have gender equality within our business. Over half of our team members are female, including having a strong representation in leadership. We're about to appoint a new independent director to the board who will be female as well. But there's a whole host of things that we think about in terms of making sure that we are representing the communities and the businesses that we act for and with. And so we do think about that in terms of our purpose and our future. I've talked about our commitment to ownership and staff ownership. It is important. It's something we'll continue to drive. And I think that partnership between people within the business and external shareholders for the benefit of everyone is a very solid way to approach business growth. In terms of the outlook for Prime, so how we're thinking about this year, in the context of the past 5 years' strong growth, is we want to continue that organic growth. We'll also have the acquisitions, which I've spoken about. There'll be new services that will start to generate a positive contribution to earnings. The accretive acquisitions I've spoken about. We'll use our scale to continue to drive ourselves forward. And we do expect for FY24 to have revenue growth of between 15 to 20%, EBITDA growth of 10 to 15%, and dividends to be up 5 to 10% for the year. So overall, we're very comfortable with our progress. I think our track record is starting to really improve, particularly the last 5 years. And we're very optimistic about building a business that can go from 26 million of revenue in FY22 through to around about 100 million of revenue by FY28 to FY30. So we're ambitious, we're keen, and we'd love to have your support if you decided you wanted to invest in us. So now I'll do the pitch, the investment highlights in terms of Prime. The track record I've spoken about already and touched on. We have been delivering on our revenue goals. It's not easy to grow organically in professional services, and I think we've found a better way of doing that for us. The M&A strategy will be part of the future, as I've spoken about. We do also have a fully franked dividend, which we do pay to our shareholders, and we do have a robust outlook in terms of earnings as well. So the business is in a good position. We appreciate the opportunity to present at forums like this, and I would love to take, without taking your job here, Paul, I'd love to take any questions that you've got.
Many thanks, Simon, and you were on the mark within 3 seconds, so very impressive. The bell was not required. Okay, so any questions, please put your hand up. Simon will be happy to answer any questions. Likewise, anyone who's on Zoom, you want to put questions through. Some have already come through, Simon, so why don't I kick one off for you. In regards, you have some very aggressive revenue targets heading to FY25, such as doubling your numbers between now and then. How confident are you that you can deliver on this?
I guess the confidence probably comes from the fact that we've had good organic growth in the past. And I guess what we've found is that we're operating in segments where there is a need for the services or the products that we're developing. So the confidence comes from having a good team, a team that's expanding and moving into markets where we know there's a need. That emerging business market, I think, is significant. There's no one that really plays heavily in that space. You find a lot of the big four accounting firms and mid-tiers do for larger companies. So I think there's a real need there. And in the wealth management space, I think post sort of Hayne Royal Commission, we're in a position now where there's actually fewer financial advisors in this country than there were 4 or 5 years ago. And I'll get the stats wrong, but there was something like 25,000 financial advisors 4 or 5 years ago. And through changes in regulation, education standards, etc., that's now fallen to about 17,000 financial advisors. So the need for advice and service for investors from a financial planning and SMSF point of view hasn't disappeared. And so the opportunity to continue to capture part because we've got a great team, is significant. So I think if we keep on thinking differently, we can keep growing organically. And the thing that we're seeing out there is that there are some other businesses that are probably struggling to grow. And so by becoming part of what we're doing and bringing their audience to our environment, I think we can help that client base get more service and also collectively help those founders be part of something that's a bit more material and a bit more significant. So the confidence comes from the past, having a pretty clear vision, but nothing's ever linear. And when the things come up that you don't expect, you've hopefully got a team that can navigate their way through them.
Gotcha. And you mentioned there's obviously a strong bias to try and grow organically, but are there any obvious M&A targets on the radar? And if so, how would you fund these acquisitions?
Yeah, so we are looking at a number of acquisitions at the moment that fit either actually in the business or in the wealth segment. The way we've funded the last transaction was when we acquire a business, we'll typically acquire it over 2 to 3 years. We'll acquire 100% and pay for it over 2 to 3 years. We do that through a mechanism of half cash and half shares on the basis of delivering the EBITDA, the target EBITDA, that we expect that business to deliver over that time frame. So far between the combination of the Westpac facilities that we've got, the fact that we're issuing scrip as part of the transaction, we've been able to meet our current requirements. But we're ambitious and we'll look to that for the future. But that's the standard model that we work on. It's very important that when we acquire a business, that the owners become owners in the broader group. So becoming a shareholder is essential. Yeah, I think that ownership, that continuing ownership philosophy is really, really important in terms of how we think about the future.
Thanks for that. A question from a couple of questions around this. You mentioned it's been, 23 was a pretty tough market, particularly in capital markets. What's your outlook for financial and capital markets over the next 12 months?
So I've become very good at not predicting the future, other than the things that you feel like you've got a level of control over. What we're seeing in real time in terms of capital markets activity is a little bit more confidence post the Christmas break. We didn't really see ever a slowdown in new engagements with companies, but what we did see is just a lower willingness to invest in new ideas. But what we're now starting to see in both the equity and the debt market is a little bit more appetite for raising capital or M&A. So we're starting to see an increased confidence, and I think there's a few people starting to predict that, but in real time we're seeing that. And look, I'm hopeful that over the course of this calendar year, we see a more normalised market. That 35 to 40% drop-off in equity capital markets was very obvious, and as confidence returns and people are looking for growth and there's a bit more of a consistent outlook on rates, I think there's a bit more confidence to come and do things.
And if you look at just in the last sort of month or so, there has been certainly signs that there's been a number of deals that have come to the market. They've been well sort of sought after. So there is early signs that the capital markets is just starting to open up again, and investor confidence is just starting to increase. Yeah. Yeah.
What appears to be the case, and is that with the larger cap companies, there's a bit more confidence to obviously participate in some of the M&A there, and it typically starts there. I think we've all been surprised as to the lag in the small and micro cap space around valuations and how long that has taken to right itself. In past markets, it's probably righted itself more quickly than it has in this current environment. And there are lots of people predicting more positive outcomes, but at the end of the day, predictions are just that. I think what we can worry about is quite simply the work we do for clients and how we run our business and delivering outcomes in terms of dividends and earnings for our shareholders. So that will be our focus.
Simon, it's been an absolute pleasure. Many thanks for taking part today.
Thanks for the opportunity, everyone. Appreciate it.